Okay, for US expats, this is huge. A 40-year wait is finally over. A massive change to Social Security is putting real money back in your pocket. But, and this is a big but, it comes with a critical tax trap. So in this explainer, we are going to walk through the exact playbook you need to protect that windfall.
Get this, $17 billion. That is the absolutely staggering amount of retroactive Social Security payments the government sent out in just 5 months. This all happened after they repealed the super controversial Windfall Elimination Provision. For expat retirees, this isn't just news, it's a massive financial windfall.
So that all sounds great, right? But here's the crucial question. Could this amazing news, this once-in-a-generational payment, actually turn into a total tax nightmare if you're not ready for it? The answer, unfortunately, is a definite yes. But don't you worry, we're going to walk through the exact steps to make sure that doesn't happen.
All right, here's our game plan for today. We'll start with the good news, the windfall itself. Then we're going to pull back the curtain on the hidden tax trap it creates. I'll show you the specific IRS solution to fix it, the right way to report your foreign pension, how to avoid getting taxed twice, and we'll wrap it all up with a really critical compliance checklist.
All right, first things first, let's talk about the good stuff. Let's dive into how the Social Security Fairness Act has completely changed the game for US expats. So let's just quickly walk through the timeline here. The law got signed in early 2025, but, and this is key, it was made retroactive all the way back to the start of 2024. That's exactly why you probably got that one-time lump sum payment back in March. It was the system playing catch-up. And from April on, your regular monthly checks should be permanently higher.
I mean, the difference here is really night and day. Before this change, if you had a foreign pension where you weren't paying into US Social Security, what they call a non-covered pension, the old rules could literally slash your US benefits, sometimes by over $500 a month. Now, poof, that reduction is just gone. Your US benefit is now calculated as if that foreign pension doesn't even exist.
Okay, so that's the good news. But, and this is a big but, that retroactive payment, well, it brings a really serious complication. It creates a tax trap.
So the heart of the problem is something called income bunching. Think about it. You got a big chunk of money that was for benefits back in 2024, but you actually received it in 2025. For tax purposes, the IRS just sees all that money getting dumped into your 2025 income, and that artificially blows up your adjusted gross income, or AGI, for this year.
And you know, an inflated AGI isn't just one little problem. No, it's like a domino effect. It can easily shove you into a higher tax bracket. It can trigger that nasty 3.8% net investment income tax. It can lead to higher Medicare premiums down the road. And, get this, the irony, it can cause a much, much bigger chunk of your Social Security benefits themselves to become taxable.
Okay, so how in the world do you fight back against this income bunching? Well, the tax code actually gives us a very specific and honestly kind of unusual tool. This is your action plan.
And listen up, because the first, and I mean most crucial step is this. Do not, and I'm going to say it again, do not file an amended tax return for 2024. Your gut instinct might be to say, hey, this is 2024 money. I should put it on my 2024 return. But for this specific situation, that is absolutely the wrong move, and it's just going to cause you a ton of headaches.
And look, don't just take my word for it. The law itself is super clear on this. The solution isn't about changing the past. It's a special calculation, an election that you perform on your 2025 tax return.
So here's the play-by-play on how this actually works. Using some worksheets in IRS Publication 915, you basically get to run the numbers 2 different ways. First, you figure out how much extra tax you would have paid in 2024 if you'd gotten the money on time. Then, you compare that to what the tax hit would be if you just dumped it all into 2025. If that first method, the 2024 calculation, results in a lower tax bill, you get to use it. And you make the election just by checking a little box on your Form 1040.
All right, so we've hopefully put the lump sum problem to bed. But this whole situation kind of shines a new spotlight on an older, really complex issue, and that's making sure you are reporting your actual foreign pension correctly in the first place.
Now this right here is probably one of the biggest mistakes expats make, so pay close attention. Most tax software you buy off the shelf, it defaults to something called the Simplified Method. That's great for US-based plans like 401ks, but it is flat out wrong for foreign pensions. The IRS sees almost all foreign pensions as non-qualified,
which means you are required to use a totally different, more complex method called the general rule.
So the general rule is all about figuring out your investment in the contract. Just think of it like your cost basis in a stock. It's the money that you already pay tax on before you put it into the pension. That part of your payout is just you getting your own money back, so you don't get taxed on it again. But, and this is so important, if your employer funded the whole thing, or if your contributions were pre-tax, then your basis is zero. And that means every single dollar you receive is taxable income.
And this formula, this is basically the engine that makes the general rule work. The exclusion ratio is just a simple fraction. It's your tax-free basis divided by your total expected payout over your entire lifetime. And that little percentage is what determines, for the rest of your life, how much of each pension check you get is tax-free.
So, you might be wondering, how do you calculate that total expected return? Well, the IRS has you covered. You have to go to Publication 9399 and look up your age in their actuarial tables. It gives you a number, a life expectancy multiple. You multiply that by your annual pension, and voila, that's your expected return. Yeah, I know, it's a little morbid, but it's the key to locking in your tax-free percentage for life.
Now, all of this logically leads to a pretty common fear, right? Am I about to get taxed on this same income by both the country I live in and the United States? Let's talk about your defense strategy against that. You basically have two main shields in your defense strategy. The first and most common one for pension income is the foreign tax credit. It's powerful. The second is the whole network of income tax treaties the U.S. has with countries all over the world. But, and this is so important, treaties come with this enormous trap baked right in. Most of them have what's called a saving clause. It's a piece of legal text that basically says, yeah, this treaty is great, but the U.S. still reserves the right to tax its own citizens on their worldwide income as if the treaty didn't even exist. It is a massive gotcha that catches so many expats by surprise.
But there's a really powerful exception to this rule, and you need to know about it. In a lot of key treaties, we're talking the UK, Canada, Germany, Social Security benefits are specifically carved out as an exception to that savings clause. This can literally mean your U.S. Social Security is only taxable in the country where you live, not in the U.S. But to get this benefit, you must file Form 8833 to tell the IRS you're taking this treaty position.
Okay, last but definitely not least, we have to talk about the reporting that goes beyond just your income. People call these the forms of doom for a reason. The penalties for forgetting them can be absolutely brutal. So let's make sure your checklist is straight.
Think of this as your non-negotiable annual checklist. First, the FBAR. This goes to the Treasury Department, not the IRS, and it's required if all your foreign accounts combined top $10,000 at any point during the year. Second is FATCA reporting on Form 8938. This one goes with your tax return and has higher reporting thresholds. And finally, just a quick warning. If your foreign pension invests in what the IRS calls foreign mutual funds, you could accidentally fall into the incredibly complex and painful PFIC tax rules, which would require filing Form 8621.
Okay, deep breath. Let's just quickly recap the action plan here. Step 1, seriously, take a moment and celebrate this huge legislative win. Step 2, hit the pause button before you even think about filing your 2025 tax return. Step 3, run the numbers using Publication 915 and see if that special lump sum election is going to save you money. And finally, Step 4, use this as a chance to review your foreign pension reporting and make absolutely sure you're using the correct general rule method.
Look, you've finally gotten the Social Security benefits you were owed all along. The question now is pretty simple. Are you prepared to protect that windfall from all these complex tax traps? The playbook is right here. It's in your hands. Now it's time to use it.